Let's get to the whole idea of Biden economics. Meghan, just pretend that Biden economics gets rolled back to some extent. What does that do to the economy?
So in terms of the economy, Biden economics, credit volatility has been very low. Part of that has been policy risk has really been in the background outside of monetary policy. So there has been deficit spending going on in the background. We think that has been a major factor in supporting GDP growth this year. As the election cycle comes into view, we are expecting that you could see more debate around that, and it will be a major factor in our GDP forecast. It's also going to be very important in terms of sectors. So typically in a political season, you'll see discussion around regulation of energy, financials, and tax policy. So those are all risks that we'll be watching in the year ahead.
What I also find so interesting is that a lot of red states are going to be benefiting from things like the IRA, as like solar panel building gets done there. And I'm wondering how that's really going to play out. Erik, to that point, if we roll back some kind of Biden economics, where do we feel that in the market? What's the impact?
Yeah, Alex, you bring up a great point about the IRA, and some of this is really hard to undo, to start rolling back some of these initiatives that are already taking hold. And let's be honest, the debate stage is very different from what happens in practice once someone's in the seat. Austerity rarely proves popular. It certainly didn't prove very popular in the 2010s. And it does feel as though there has been a bit of a structural shift in how some of these candidates and these parties are thinking about spending. So, if there is real austerity, that's surely one way to reduce inflation. But I'm a little skeptical that we're going to see a shift back to the 2010s austerity.
Well, sure. I mean, they're obviously very different. A different way, I guess, of asking that, and Meghan, maybe this is for you, because you do see those higher rates. Are we going to see structurally higher inflation because of this kind of long-term spending, right? Like it's going to come off over the next 5 to 10 years, even if some of it sticks.
So we do expect that inflation will be, I think, stickier than people expect. But given our forecast that the Fed does hold for an extended period of time, we do think the Fed will eventually reach their goal. It's just going to take a lot longer than people have baked in. So, well into 2024, as we see inflation start to come down. I think for us, we're really focused on that trajectory and how that feeds into earnings. So people are forecasting an improvement in earnings into next year, which definitely goes against this whole goal of bringing down inflation and some of the deceleration that we've seen.
Yeah. Erik, what do you think? Structurally higher inflation at some point?
Yeah, look, a lot of these arguments, Alex, make sense to me. I mean, whether it's the building out of green infrastructure, the tailwinds from IRA and labor demand, certainly some other factors at play here. But some of the factors like structural, technological improvements, these things haven't really changed. A lot of the friend-shoring, reshoring narrative is mostly just a narrative. It's hard to see that in the data so far. So I'm not fully convinced, but at least for the next 2 to 3 years, it's hard to get the genie back in the bottle. And I think you're looking at least more inflation volatility, perhaps around a higher average as opposed to a quick return to 2%.
Well, that's a really more inflation volatility. That's a good one. All right, guys, thanks a lot. Really appreciate it. It was fun to catch up with you, Meghan Robson and Erik Nelson. Thank you very much.